Let me be absolutely direct with you right now, because nobody else in this space has the nerve to say what I'm about to say to your face. You missed Nvidia, you heard about it, maybe you even looked at the chart. Maybe someone sent you an article and you did nothing. You missed Palantir. You watched it climb from $8 to over $70, and you stood on the sideline telling yourself it was too risky, too speculative, too late to get in. And right now, today, as you are watching this video, you are sitting on the edge of the exact same moment for the third time in a decade. Except this time, the technology is not an AI software platform. This time, the technology is so fundamentally disruptive that it makes artificial intelligence look like a warm-up act. The question sitting in front of you right now is brutally simple. Are you going to make the same mistake for the third time in a row, or are you finally going to pay attention? Because I am only going to say this once, and the window does not stay open forever. Before we go a single step further, I need you to do one thing, and I need you to do it right now, before your attention wanders and you convince yourself you'll come back later. Because you won't. Hit the subscribe button. Everything I'm about to share with you, the research, the numbers, the specific companies, the analysis. This is the kind of work that professional fund managers charge $20,000 a year to deliver to institutional clients. You are getting it for free right now in this video because you found this channel that is either the best financial decision you have made this week, or you are going to scroll past it like you scrolled past Nvidia in 2013. Subscribe now. Your future self will either thank you or hate you. That is entirely your choice. I want you to sit with the number for a moment, and I want you to feel it, not just hear it. If you had taken $10,000 and put it into Nvidia in 2013, the year our charting software first flagged a clean breakout on that name, you would be sitting on approximately $1.2 million today. That is not a projection. That is not a hypothetical. That is a mathematical fact. 120 times your money. $10,000 turned into the kind of money that pays off a mortgage, funds a college education, and changes the entire financial trajectory of a family. And the majority of people watching this video right now did not do that. Not because the information was not available, not because the signal was not there, but because they found a reason to hesitate. They told themselves it had already run too far. They told themselves they would wait for a pullback that never came at the level they were waiting for. They told themselves semiconductors were too complicated to understand. Now let us talk about Palantir. If you invested $10,000 into Palantir at its IPO in September of 2020 at a price of around $10 per share, and you held that position through to where it trades today, you are looking at a return north of 600% on that money. $10,000 became somewhere north of $70,000. And the people who bought it at the breakout above $25 and rode the institutional momentum that we track and teach. Some of those people saw multiples of that. And once again, the information was there, that the chart was there, that the thesis was clear. And the majority of retail investors either missed the entry entirely, or they bought at exactly the wrong moment near the top because they finally caved to FOMO after the hard work was already done. And then they held to a painful drawdown and sold at a loss on a stock that ultimately went on to make other people very wealthy. Here's what I need you to understand about both of these stories. And this is the part that nobody in financial media actually explains to you with any intellectual honesty. These were not lucky guesses. These were not accidents. These were predictable outcomes of a pattern that has repeated itself in American economic history with remarkable consistency. Every single generational wealth creation event in the last 100 years has followed the same arc. A genuinely transformational technology emerges. Early institutional money flows in quietly. The technology begins to prove itself in the real world. Then the retail wave arrives, usually late, usually near a peak, and usually without an exit plan. The technology eventually justifies every dollar of hype and more, but the retail investor who bought late and held blindly often ends up with far less than they should have, despite being right about the technology itself. The ones who win are the ones who understand the pattern, get positioned early, and have a disciplined plan for both entry and exit. That is the entire game. And now that game is starting again, except this time the stakes are bigger than anything Nvidia or Palantir ever represented. What I am about to explain to you is the single most consequential technological shift in human history since the invention of the microprocessor. And I do not say that lightly, because I have been investing through several of these cycles, and I understand exactly how absurd that sentence sounds the first time you hear it. But let me give you the math, and then you decide. A regular computer, the one in your pocket, the one on your desk, the servers running every bank and hospital and military system on the planet, all of them operate on a binary logic system. They process information as ones and zeros, one calculation at a time, very fast, but fundamentally sequential. The quantum computer operates on an entirely different physical principle. It uses qubits, which through a property called superposition can represent 1 and 0 simultaneously, meaning they can process an almost incomprehensible number of calculations at the same time rather than one after another. The practical implication of that architectural difference is so extreme it sounds like science fiction until you look at what has already happened. In December of last year, Google unveiled a quantum chip called Willow. That chip solved a specific computational problem in under 5 minutes. The same problem would take the most powerful classical supercomputer currently in existence 10 septillion years to solve. I will give you a moment with that number. 10 septillion years. The universe is approximately 13.8 billion years old. We are talking about a computational advantage so vast that the word advantage does not even begin to capture it. And this is not a laboratory curiosity anymore. This is deployed hardware from one of the most well-funded technology companies in the world, and it is accelerating. Now let us talk about why governments are treating this like a nuclear arms race, because that framing is not dramatic, it is accurate. The United States Department of Energy has renewed $625 million in funding across 5 national quantum research centers. The Department of Defense has formally requested nearly $1 billion for quantum-related research and development. The National Science Foundation is investing a further $100 million, and outside the United States, the picture is the same. Globally, governments have committed over $65 billion to quantum computing programs. China, the European Union, the United Kingdom, India, Australia, all of them are running national quantum programs at the scale you only see when a government believes the technology is existentially important to national security. Why does national security care about quantum computing? Because the most powerful quantum computers, when fully realized, will be able to break every encryption standard currently protecting every piece of digital infrastructure on the planet. Every bank, every hospital, every military communication system, every nuclear facility, every piece of classified intelligence, all of it runs on encryption that a sufficiently advanced quantum computer can crack. This is not theoretical. Researchers have already demonstrated the algorithmic pathways. The race right now is not about whether quantum will break encryption. The race is about who gets there first and whether you have quantum-protected infrastructure before your adversary does. This is the same logic that drove the space race and the nuclear arms race. The difference is the economic opportunity sitting on top of this existential competition is projected to reach $850 billion by 2040. That is 30% annual growth compounded for 15 years. And you are watching this video right now in 2026 when the first commercially viable quantum companies are just beginning to show real revenue. This is 1993 for the internet. This is 2012 for smartphones. This is that moment, and it is happening right now. Let us get to the specific companies, because I am not here to give you a history lesson. I am here to give you actionable intelligence, and that means names, numbers, and theses. There are 3 pure-play quantum computing stocks worth understanding right now, and I'm going to walk you through each one with the same analytical discipline I apply to every position I have ever taken. The first company is IonQ ticker, IonQ, and it is the revenue leader in this space by a significant margin. Let me give you the numbers because this is where most people stop reading research and start guessing. IonQ became the first pure-play quantum computing company to cross $100 million in annual revenue. They generated $130 million last year in just the final quarter of 2025 alone. They reported $61 million in revenue, which represents 400% growth year over year. They are projecting over $200 million in revenue this year, which is essentially doubling the business in 12 months, in a sector where the majority of companies are still running science experiments and generating $5 million a year, if they are lucky. IonQ is building a real commercial enterprise with real customers paying real money for real products. But the revenue story is not even the most important thing about IonQ right now. What I want you to understand is the strategic positioning they have just executed with the acquisition of SkyWater Technologies for approximately $1.8 billion. SkyWater is a US-based semiconductor foundry with something called DMEA Category 1 accreditation. That designation means they are approved to manufacture chips for the United States, military and defense agencies. That accreditation is extraordinarily difficult to obtain. It is a competitive moat that cannot be replicated quickly by competitors. By acquiring SkyWater, IonQ has become the first vertically integrated quantum company, meaning they now control the entire process from chip design through to chip manufacturing. Think what that means strategically. They are no longer dependent on external foundries. They control quality, they control timelines, they control iteration speed. This is the Tesla model applied to quantum hardware, and it matters enormously for the contracts that are coming as government spending accelerates. On top of all of this, 80% of IonQ's revenue comes from commercial customers, not the government. That diversification is critical because it means they are not a single customer dependency story. They have real enterprise demand across multiple verticals. The valuation is expensive, trading at roughly 60 times forward price to sales, and they are still losing money on the bottom line. Those are real risks, and I will not pretend otherwise. But in terms of revenue execution, customer diversification, and strategic positioning within the quantum computing sector, IonQ is in a class of its own right now. The second company is D-Wave Quantum, ticker QBTS. And I need you to pay careful attention here because D-Wave is doing something fundamentally different from every other quantum company. And that difference is what makes them commercially interesting right now, rather than 5 years. While IonQ, Rigetti, Google, and IBM are all building what are called gate model quantum computers, D-Wave uses a different approach called quantum annealing. Do not get lost in the terminology. Here is what it means in practice. Quantum annealing is specifically optimized for solving complex optimization problems. The kind of problems that sit at the heart of modern business operations, finding the most efficient delivery route for a fleet of 10,000 trucks, scheduling thousands of workers across hundreds of shifts with dozens of constraints, optimizing a global supply chain with hundreds of variables changing in real time. D-Wave's technology solves these problems today. Not in 5 years, not after the next funding round. Today. Their revenue was approximately $25 million last year, which is small, but the growth trajectory is real and the customer base is meaningful. They currently have 135 enterprise customers, including names like LG and Sharp. And here is the detail that genuinely surprised me when I dug into the numbers. D-Wave is generating software-level profit margins on hardware that is genuinely novel, genuinely complex, and genuinely difficult to manufacture. Their margins on this hardware are better than Nvidia's. Let me repeat that because it deserves the weight it carries. A small quantum computing company that most retail investors have never heard of is generating better hardware margins than the most important chip company on Earth. That does not happen by accident. That happens when your product is so specialized, so differentiated, and so genuinely useful that customers have no alternative and are willing to pay premium prices to access it. The company has scheduled an investor day for June of 2026. I want you to understand what that signal means. Companies in trouble, companies whose numbers are deteriorating, companies whose customers are walking away. Those companies do not invite institutional investors to spend a day with their management team on the floor of the New York Stock Exchange. That is an event you organize when you believe the story you are about to tell is compelling. It is not a guarantee of anything, but it is a signal worth noting. D-Wave is high risk. Their revenue needs to scale materially from $25 million to be a genuinely transformational business. But the technology works today, the margins are exceptional, and the commercial traction is real. The third company is Rigetti Computing, ticker RGTI. And I am going to ask you to do something that most investors are completely incapable of doing. I am going to ask you to separate the revenue number from the technology story. Because if you cannot do that with Rigetti, you will miss what may be the most asymmetric risk-reward opportunity in this entire sector. Rigetti's revenue last year was $7 million. It declined 56% from the prior year and missed analyst estimates. On paper, that looks like a failing business. And I understand completely why the majority of retail investors who see those numbers close the browser tab immediately. That is actually one of the reasons the opportunity exists. Here is what the revenue number does not tell you. Rigetti achieved a 99.92% 2-qubit gate fidelity at 28 nanosecond gate speed on a prototype chip. That is a technical specification, and I know that your eyes are beginning to glaze over. So let me translate it into plain language. It means Rigetti's quantum chips are currently the most accurate quantum chips on the planet, and they have a new chip called Enka scheduled for deployment later this year that uses this technology at commercial scale. But the deeper competitive advantage at Rigetti is not just the chip performance. It is the fact that Rigetti owns and operates its own quantum chip fabrication facility. Every other quantum computing company outsources their chip manufacturing to external foundries. Rigetti builds their own hardware from scratch, in-house, under their own quality control. That gives them iteration speed, manufacturing control, and a depth of hardware knowledge that competitors who outsource Their manufacturing simply cannot replicate. And then there is the partnership ecosystem that tells you exactly how seriously the most important players in technology are treating this company. Nvidia has selected Rigetti hardware for integration into their open quantum AI platform. Nvidia is the most important semiconductor company in the world. When they evaluate every quantum hardware platform available and choose to integrate with yours specifically, that is not a courtesy arrangement. That is a technical endorsement from the organization with arguably the most advanced understanding of computational hardware architecture on Earth. Beyond Nvidia, the UK government has committed $100 million to a Rigetti deployment. India has signed their single largest hardware contract ever disclosed, and a $250 million partnership with Quanta in Taiwan positions them for commercial scale manufacturing with one of the most capable electronics manufacturers in the world. The revenue is not there yet, but the technology leadership is real, the partnerships are serious, and the fabrication ownership is a structural advantage that becomes more valuable as the market scales. If you are looking at Rigetti and all you see is $7 million in revenue, you are looking at the wrong thing. Now I need to tell you something that most investment content creators will never say out loud because it makes their stock picks look complicated and it makes their audience feel uncomfortable. Here's the truth. Every single stock I just described to you went up over 800% in 2024. IonQ was up over 1100% from our entry. Rigetti was up over 800%. D-Wave was up significantly as well. And the majority of investors who owned those stocks through that entire run did not capture anything close to that gain. They either bought near the top because they finally gave in to the excitement after watching it run for months, or they bought early and correctly and then watched the entire gain evaporate because they did not have a plan for when to sell. Here is the specific mathematics of what happened. All three stocks peaked at virtually the same moment, not approximately the same time, the exact same week. Someone institutional flipped the switch, and all three quantum stocks began a correction simultaneously. IonQ fell 70% from its peak. Rigetti fell 70%. D-Wave fell 45%. The person who bought IonQ at the peak of the hype cycle with $10,000 and held it through the correction is now sitting on $3,000. The person who bought the same stock at the entry point, our methodology flagged and sold anywhere near the top, is sitting on over $100,000. Same stock, completely different outcome. So the variable was not the stock pick. The variable was whether or not the investor had a systematic, rules-based plan for when to exit the position. This is the mistake that costs retail investors more money than any other single factor in the market. Not bad stock picks, not bad timing on entries, the complete absence of a selling discipline. You watch a stock go from 10,000 to 100,000 on your screen, you feel the euphoria. And instead of executing a predetermined exit that you agreed with yourself on the day you entered the position, you hold and you tell yourself it is going to go higher. And maybe it does for a day or a week. And then it does not. And you are suddenly watching $100,000 become 60,000 and then 40,000. And you still do not sell because now you are in the psychological grip of trying to get back to where it was. This is not a character flaw. This is not stupidity. This is a completely predictable human response to financial gain and loss. But it is entirely avoidable with a system, and that system is what Wall Street has understood and protected for 50 years while ensuring that retail investors never learn it. Let me tell you exactly what that system requires, because you deserve to understand the principle even if we do not have the time to go through every rule and every scenario in this video. The most important concept in disciplined investing is this: the moment you enter a position, you must already know the specific conditions under which you will exit it. Not approximately, not when it feels right, not when the news turns bad. Specifically, at what price level, at what percentage gain, at what technical signal, or at what change in the fundamental thesis will you sell the stock. That decision must be made before you are emotionally invested in the outcome. Because once you own a stock and it is moving, your brain is no longer making rational calculations. Your brain is making emotional calculations disguised as rational ones, and it will consistently lead you to hold too long, sell too early on the downside, and re-enter at exactly the wrong moment. For a long-term investor with a 10-year horizon on quantum computing as a sector theme, the system looks different than it does for a momentum trader, capturing a specific breakout run. The long-term investor needs predetermined rules around position sizing, around how much of a drawdown they are willing to accept before reducing exposure, and around what fundamental changes to the thesis would require an exit, regardless of price. The momentum trader needs technical signals for when the institutional buyers who drove the move are beginning to distribute their shares, because when institutions sell, they do not announce it. They sell quietly over weeks, and by the time retail investors feel the shift, the smart money is already out. Both systems exist. Both work when applied with discipline. Neither works if you improvise, because improvising means your emotions are making your decisions, and your emotions were not designed for financial markets. They were designed to keep you alive in a world where standing still was dangerous and moving fast was survival. In financial markets, the opposite is often true. The investor who moves slowly, deliberately, with a pre-written plan, and executes that plan without deviation, is the investor who wins over time. The investor who reacts, adjusts, overrides their own rules because this time feels different, is the investor who turns 10-bagger stocks into net losses and then wonders why the market never works for them. The opportunity in quantum computing is real. The 3 stocks I walked you through represent genuinely different risk-reward profiles and genuinely different commercial theses. IonQ is the revenue execution story. D-Wave is the commercially deployed technology story. Rigetti is the technology leadership and asymmetric upside story. Each of them carries real risk, real volatility, and real potential. But none of that potential matters to you unless you approach your entry with a defined exit strategy already in hand. The technology is not the variable. Your discipline is the variable. I'm going to leave you with this, and I want you to hear it not as motivation, because motivation is temporary, but as a mathematical statement about cause and effect. There were people in 1993 who understood that the internet was going to change everything. They had access to the same information you have access to right now. They saw the government funding. They saw the early commercial applications. They understood the scale of what was coming, and a large number of them did nothing because they were waiting for more certainty, for a better entry point, for the perfect moment that never arrives. Those people are not wealthy today. From the internet, the people who acted, who made a decision with imperfect information in an uncertain environment, who had a plan for both entry and exit, and who executed that plan with discipline. Those are the people who built generational wealth from the single greatest technological revolution of the 20th century. Quantum computing is the equivalent event for this generation. The government money is flowing. The technology is proving itself in the real world. The first commercial revenues are appearing. The institutional positioning is beginning. This is the early stage. This is before the mainstream financial media has built a full narrative around it. This is before your neighbor is asking you about quantum stocks at a dinner party. That moment when everyone is talking about it, that is not when you want to be buying. That is when you want to already be positioned, already profitable, and already executing your exit discipline, because the top is somewhere near. Right now, you have the information. You have the specific names. You have the framework for thinking about this correctly. The only variable left is whether you are the person who acts on what they know or the person who watches someone else get wealthy from information they were handed. That is not a rhetorical question. That is a choice you are making right now, today, in the next 60 seconds. Because the people who watched the Nvidia video in 2013 and closed the tab are not millionaires. And the window on quantum is open right now. The question is whether you are going to walk through it.